Hey everybody, welcome to the channel. This is Fast Entrepreneur and my name is Justin. Let's get into it. This video, I want to talk about diversification. I've had some people ask me, what does your portfolio look like? And it really all comes down to one word, diversification. And I want to say that I'm not a financial advisor, right? This isn't financial advice. I'm just a guy that drives in his car, follows crypto. I do have a background in economics and finance. So I do know a little bit, maybe more than the average Joe about diversification, but let's get into it. So what is diversification and why is it important? Well, diversification in a nutshell means that you don't put all your eggs in one basket, right? Because if you're holding the basket and then you trip and all your eggs break, yikes. So what you try and do is you try and diversify. You try and put, in this case, not eggs, but you try and put your assets, your dollars, to work for you in diversified places, in different places. And really, if you truly want to diversify and get all nerdy, it has something to do with correlation amongst assets. And the best way you can diversify is if you're in a basket of uncorrelated assets across multiple asset classes, across different currencies, across different countries, etc. So, when you're looking at your whole portfolio, right? You don't want to just think about crypto. I talk a lot about crypto. But, you may want to diversify and say, and again, this does depend on your risk tolerance. But if you're truly diversified in the true sense of the word, then this is risk adjusted. And I mean, like in the stock market, for instance, most people probably have access to like a 401k or an IRA, where most of their assets are actually not in one stock or a few stocks or bonds. They're in what they call index funds. And these index funds are literally multiple, it's many stocks and many bonds in one place. So if one goes up and another goes down, it kind of, hopefully will level each other out. And if you're truly diversified, you'll have, some index funds in, US dollars. You'll have some in, other currencies, Asian currencies, Latin America, etc. So there are ways, and you don't have to weight these equally, right? You don't have to go, equal footing, because it might be more risky, to have your assets, say, in emerging markets, like, third world or emerging second world countries, as compared to maybe first world countries where maybe things aren't as volatile. The crypto world is very volatile. So, I mean, it's very common sometimes to see, dips 10 to 15% in a day in the crypto world, whereas, not so common to see that in the stock market in an index fund. But if you want to just talk about crypto portfolio, okay, so let's say you've already found out, you say, okay, I don't know what it is for you. Maybe you say, I only want 5% of everything that I have to be in crypto, and the rest I'm gonna, keep some in my savings account and some in my stocks and some in real estate, or some in checking account, or some for whatever. That's fine. Whatever's right for you and your risk profile. But when it comes to crypto, people ask me, well, where's your portfolio? The same principle applies, and I'll say, I mean, whether or not, I'm me, you're you, so we might have different risk tolerances. We may have different understandings of finances, financial markets, crypto markets, etc. So, with that, maybe something that maybe is more risky to somebody else, maybe less risky to another person. There's also, trading techniques that can also help to limit your downside, your risk. that maybe not everyone does or takes advantage of. But in the crypto world, just to spit it out, how do I think about like a crypto portfolio? And to me, it comes down to diversification. I like to explore crypto. I like to learn about the crypto space. But at the same time, I have certain reasons for doing certain things and investing in certain projects. And there are certain projects that I think are probably, lower risk projects in terms of, a bull market cycle. And those would probably be projects like Bitcoin, like Ethereum, the top 10. And if you go to CoinMarketCap or CoinGecko, you can actually see all the different cryptocurrencies. The further and further you go down out of the top 10 coins, and then into the top 20 and the top 50, and then in the top 100, the further you go down, in my opinion, you may have greater chance for upside, gains, but you also may have greater chance, for downside. And especially as you venture down into, page 2, page 3, page 4, page 5, you may find a project, that has a super small market cap, and it has the potential to go 20x, potentially. But it also has a potential, to not go anywhere or to lose, 90, 95%, or to get rug pulled, or, have hacks, or, something wrong with a smart contract, whatever it may be. So there's a lot of risks, and the goal about diversification in a nutshell is to try and diversify against all risks. And listen, life is risk. There's no way to get away from risk. There's no way to truly eliminate all risks. But by doing, diversifying amongst asset classes, you can reduce or mitigate your risk. And, if you study finance, you'll get into this and how they calculate all this, and modern portfolio theory. I remember some of this stuff in the CAPM model and stuff. Just what this stuff is saying is that there are model portfolios that you can create to actually have a higher expected return while taking on lower expected risk. I mean, that truly is the holy grail, right? It's that's why something like an arbitrage opportunity, true arbitrage, is very low risk, but there are elements to arbitrage that could be risky. But and if you don't know what arbitrage is, you can look that up, but it's basically where you buy something in one market, you sell it, the same thing, in another market, and for a higher price. If you can do it simultaneously, if you can do it without, price slippage, if you can, if you can eliminate exchange risk, if you could, there are risks along the way. But if you can do it, you could potentially limit or mitigate much of the risk. And arbitrage opportunities sometimes could be the closest to free money, in terms of a trade. But there still are risks, so don't get me wrong. There's risks everywhere. So best way that I would say for myself, is to diversify amongst, in crypto, to diversify amongst, have some into the top 10, some into the top 50, some into the top 100, some into those, low cap, mid cap degen coins that might go, some into meme coins, some into, then diversify amongst platforms, some in Ethereum, some in Binance Smart Chain. You might want to even explore, different, you might want to explore Polygon now. You might want to explore, some other, you may want to diversify, in different areas. You might want to have some in DeFi projects. You might want to have, some in NFT projects. You might want to have some in Layer 1 projects, some in Layer 2 solutions. There's, stable coins obviously aren't going to grow for you, but, you may want to diversify your risk by not having all of your funds on one exchange, not having them all on a centralized exchange, to kind of, split them up. It diversifies so that in case of something bad, whether it's a hack or a price drop or whatever it might be, your overall portfolio can at least survive and can continue moving forward. Hope this video helps you. Diversification. Name of the game.